Morning, everybody. As I said, I'm Lesa. I'm a registered financial planner. This kind of form part of my role. What we do at RBC, I'll just talk a little bit of RBC just to give you some background. It's what we call kind of lifestyle planning. And what we try to do, we do have some information what we call investing in education. So this particular presentation is kind of more skewed towards parents who want to finance their education, but there is some information in here for adults who are looking to finance their education as well. But most of the information will be more towards parents, but we can always work to suit. So what we're going to discuss today is just we're going to go through, let me just read through the agenda. We're going to talk about education as an investment, how to fund your education. We'll look at savings plan. How can you save for your education? How can we use credit wisely to get our education? And what we need to do today to get it done. One of the things we want to know is why we're doing anything that we're doing. Because we know we like to talk about higher education, and some people just like to say, okay, I have an MBA. But what's the point of having an MBA? What's the point of having a doctorate? What's the difference? What difference does it make to you? And I just want to be a little interactive today, so I'll ask, anybody have what do they think about when you think about financing education for, let's say for your children? Why would you want to invest in education for your children? Yeah, and that's good too. It also, if you think about it wisely, it also helps the country as well. And then for their independence as well is really important for children to have that education. What I like to say is too, that sometimes we think of education only as the tertiary education that we give in our children. So yes, they go to school, they go to college, they go to university. But then what about the skills? I mean, if you think about it like a nail tech, I always say, and even if you're looking at that, but it's looking at how do you even invest for that, because you can be a nail tech learning from the girl down the road, or you have people going to New York, who going to London and France to learn hairdressing. So it's not necessarily, when we talk about investing in education, it's not only the education, the tertiary education that we know about, but it's how do we give them the skills and the opportunities that make them independent and productive. One of the things that we look at is really improving your chances of employment. I mean, if you look right at Trinidad and Tobago, one of the things I did, my daughter is now 18, she just finished CFC, and she got 7, but I send her right now, she's learning to do nails, she's learning to do hair, she's learning bartending, and I just thought for this year to do that, just based on what I am seeing happening, because I have people who have masters who are unemployed, and I think all of us just need to have that skill as well. But it really, having any kind of education really makes you more employable. But when you look at it across the economy, people without college degrees always better employed. No matter what happens in the economy, especially according to what areas, and you really want to look at what fields you're going into. I always say to people, do what you love, because even if it is, let's say you love photography, even if it is you're not employed here, you are going to find ways of using photography always to earn an income. You'll think about, okay, let me go and take a picture of the neighbor child, something. You're going to find a way because that's your love, that's your passion. So we want to all of us would love to have doctors and lawyers as our children, but the child may not want to do that. So sometimes we kind of try to live our dreams to our children, but it's really how do we find that skill and give them that they need to do. It also makes you earn more. The better skilled you are, you have better earning potential, and it really is an investment. If you take $200,000 and you put it into the bank, even if you get a good investment, now in this economy you may earn 5%. Think of putting that $200,000 in your child education, how much return, or even in yourself. Think of how much return you're going to get. So it really is a good investment. So I just wanted to lay the groundwork that education is really an investment, and how do we get to that? We want to talk about some ways of saving. And some of the ways of saving are self-funding, which is where you save your money up for the education, or like for a parent or a child. Sometimes you have to do family and friends will give them money as well for education. From current earnings, some people who are employed, they will say, okay, let me work for 2 years and kind of sacrifice and save that money, so I'll have it down the road. People who get gratuities and bonuses at the end of the year. Some people I know who work right at RBC, they take the bonus every year and invest it in like a course or education, because to them that's the better investment for them. Even people work full-time and part-time, and then there are loans available as well, which we'll talk a little bit about. How do we save for from a parent's perspective, so let's say you were saving for your daughter university education. From today, you can sit and say, okay, and most times you can tell how much a university education is going to cost. If you just look at the average cost, you say today and you say, how much is it going to cost for her to go to university at that time? The challenge that most people end up in is that they say, I'll save as much as I can. So this month I'll put a $50, next month I'll put a $200, next week $300, okay, if I get a bonus I'll put $1,000. And then, but that really is not saving towards the goal. Because what you want to know is how much do I need to have? Because saving as much as you can, when she turns 18, you may end up with, let's say, $20,000. That really is not going to do anything. So you really want to know how much do I need? And then you save towards that goal. So you know I need 100,000. This is what I need to save today. Now the fact is, let's say you need to save $1,000 a month today. If somebody came to me today and said you need to save $1,000 a month from today, it will never happen. Because then I'll have to starve. I'll have money for education, but she wouldn't eat. But it's about knowing where we need to go and how do I start today. So even if I start, let's say, with $100 today, as I work every year, we get salary increases and things like that. But you really want to always know what the goal is. How much do I really need to go where I need to go? Divide. And what we want to also do is to set up 4 savings plans. I would love to say always that I am disciplined and I would save, I would not. So for myself, what I have done is to set up 4 savings plans, and how I do it is through suits. Some people have a standing order, they set up at the bank so the money comes out one time. Even for me, even if it comes out and goes to another account, I will go in the other account. I'm just being honest. I walk down the road and see some nice shiny thing and I would buy it. So Susu works for me that, you don't get the money until once a year, and that once a year I always have a goal set for it. So I know, okay, this is to buy a fridge. So I take it one time and I buy the fridge, so I know that was that goal. But it really works that way. But you have to know yourself as well. Know what works for you and how you can accomplish it. And I know some people who would put that money will stay in the account and they'll never touch it. So, but it's really knowing yourself and what you need to do. One of the big things though is decide where you would save it. People say all the time, the bank's not paying any interest, or they say, I have that money in the account and I'm not getting anything on it. Understand where you're saving and what you're saving for. Money in a savings account will never grow. Never. Because it's not meant to grow. It's meant to just be there and your capital is preserved. And now with the interest charges, the service charges, it is going to dwindle. So you can't be saving for 18 years on your child education and have it in a savings account. Nothing is going to happen. It is not going to grow. And you really want something that grows. One of the things I recommend for parents, Unit Trust has an account called a Children Investment Starter Plan. They really invest that in growth objects. But the good thing about it, most commercial banks, because most people who have mutual funds, they do have a growth fund or income and growth fund, something with growth. The difference with Unit Trust is that they guarantee it if you leave it for more than 3 years, once it's funded in there for more than 3 years, because growth funds are a little more risky. And because it's a little more risky, there's that risk involved. You can make a lot of money because it grows, but it also, as great as it grows, it can also go the other way. But the Children Investment Starter Plan, they kind of guarantee it once you leave it there for 3 years. The government is a guarantee that they guarantee themselves, but more often than not, it's going to work out for you. And you kind of set up, the other good thing about it is even if it's in your name, but even if you pass away, it stays there for the child until they're ready for it. So I kind of like to recommend that to parents. But if you're saving towards education, what you have to do is to know your time horizon. If it is, let's say you were saving money to study next year, then obviously not. Because in that year, if it goes down, and you're ready for it. So you would want something like a money market fund, but it's really understanding where am I saving and what do I want to accomplish by it. That's really the trick as well. And always keep in mind what the funds are for. So some of the things that I really recommend is having different accounts. And this is just based on my experience. Like if I have all my money in my account, which is for my children's education and for long-term goals and everything, then all that is going to end up for short-term goals. Because if I go and I see something and it's in there, it's available. So it's kind of knowing yourself and you put that in a different account. But it's understanding what the goals are and which account I should choose. And sometimes if you go into any institution, then most times they may have a financial planner or just somebody who understands investment who can give you advice on what kind of account you can choose. Any questions? Yeah. Sorry? Right, so stocks would be good. Because remember, you invest in a company. In investing, the only thing that grows are companies. Bonds don't grow. Because bonds are really meant to provide an income. So you buy a bond for, let's say, $100,000 bond. When it matures, how much you get? $100,000. What you get in between is that coupon you get all the time. So you have to know what it's for. So if you have a child that you want to get an income every month, or somebody who, income fund is for really people who are looking for that consistent income every month. For education, it would be stocks. So if you don't want, let's say, a good fund, then you can, of course, buy shares on the stock market. So you could say, okay, let me invest in SBCS shares, just to call one. First, for a child's education, it's up to the parent what their risk appetite is, but I would prefer income and growth fund because it has that balance in stocks and bonds. And sometimes when stocks go up, bonds go down, so you still have that kind of balance to kind of even it off. And remember, when a child 18, you can't say market's down today, you can't go to school if they're ready, So I prefer the mutual fund with that balance rather than going directly into a stock. Because yes, it's like a SCB share, let's say you buy today. I think that's a good dividend share, but not necessarily a good growth share. And you want something that would grow. So it's just understanding. But stocks, absolutely, stocks are that education. Yes, I'm coming to loans. Loans is next. But yes, that's a good point. And then too, it depends on what your goal is. Especially if you have saved all these years, and let's say you save $200,000. It really is difficult sometimes to take out that whole $200,000 and to put it to the education. And difficult because you're kind of depleting the entire savings. So you have nothing there for emergency if anything happens. So sometimes, especially if you qualify for the loan, take the loan. And you can even use, some people use that $200,000 to secure the loan so you pay a lower interest rate. But it's really, for me personally, it really is a better option than depleting your savings. If you have $10 million, or let's say $1 million, then it really is there because you have more money to fall back on. But especially if you have been saving, and let's say the child decides to go to university abroad, we know how things happen. Anything happen, you really have to now run to get a loan to see if you could, or somebody could help you out with that. But it's always good to have that cushion there as well. But I'll talk a little bit about that as well. I have a slide here that talk about investing plans for your child education and how much years you could go. I would try to see if they could print it for me so I could give it out. I would ask. But it talks about where you want to invest, at what stage in your child's education plan. One of the things I see parents doing all the time is taking out an insurance plan for the children. To me, honestly, and no offense to the ones who have done it, it really makes no sense. If it is that you are saving for your child, you're taking an insurance plan in case they die. If your child dies, you really want $1 million? But what happens if they live? You understand? And this is not for parents who can afford to do all. This is for the parents who are trying to see how to invest for their child. Because really, do you really want your child to die anytime? That's your plan? What are you really planning for? What you're really planning for is so when my child comes 18 to go to university and to study or whatever. So that money, if you have $500 to spare, rather than put that in an insurance plan, that should really go into a savings plan for your child's future. Life insurance we're talking about specifically. And then this is just, for me personally, I don't understand why I would need, what I would have for my children is a health plan that covers them if they get sick. So the health plan covers them if they get sick, whatever. And me personally, I would not mix it, but in everything with investing is understand what you prefer and what works best for you. I personally, and it's your choice, if you think that, okay, that I still want that life insurance in case of something, I don't. Because I just kind of want to measure what do I prefer to do with my children at that stage. And investing is always that you have options. In everything investment is options, and make sure you make an informed decision that you understand. So like for my children, I always tell them, I'm leaving you nothing. I said, when I turn 60, I'm selling the house and travel the world. I mean, not really. But I really don't think that I have an obligation to provide, like pay for my child to do a master's. I will never pay for my child to do a master's. I shouldn't say never, but that is nowhere in my plan. I have a client now who's paying for his daughter to do a doctorate. But that's his choice, and that's his plan, and that's where he is. So everything in investing is understanding where you are, and you make an informed decision that is best for you and that's best for your family. Understand? So for me, with that health plan, my insurance will cover them now if they get sick up to $3 million. I really don't need nothing else. What I want to save for is for them to really get that independence where they can go out to school. But that's just based on where I am and how much I can afford to save. But there are people who can afford to save both kind of things. So like if your child is just born, let's say you have a 0 to 8-year-old child, there's really no value in, let's say, putting in a savings account. People come all the time to open savings accounts and they say, my child just born, I want to open a savings account to save for them to go to university. If you are putting $50 a month, in the first place, $15 coming out for service charge. Because even if we say FCB is a good dividend share, a bank, especially a bank that is a FCB style bank, is going to go. It's 18 years time frame you have, even if the dividend, and then it is going to go over that 18 years. So you can, and this is not saying to buy one stock, because it's a trial you have time. So diversify your portfolio. You can go full growth with an 18-year time frame. You don't even need that diversity really. You can go full growth. You can diversify across stock. Let's say the child a little older, 10. I would say from like age 10, you want to put some bonds in there to kind of mix it up to have that balanced portfolio. And then as you go closer, I would say from like age 15, 16, then you need to kind of pull in and kind of move out of the stock market and kind of put it in kind of money market, something a little more secure where 16 to 18, at 18 you have that money for you. But it's understanding your time frame and horizon kind of thing. So different things based on where you are. I recommend credit union to certain people, but again, it always depends on you and on the people. What people don't understand is the risk associated with a credit union. When you invest, and you have to really do your research across credit union. When you invest in a credit union, you are really buying shares in the company. There's nothing that says, I'm going today to take out my money and I can't get it. And I hear people come to the bank all the time and say, I went to the credit union and they don't want to give me my money. You invested in the company. You really have no, but it's just understanding the credit union. Some credit unions do pay good dividends. One credit union I know last year paid 5%. In this economy, if you could get 5%, it is a good return. But you really have to do your research. Your credit union paid 5%? 5.25. Yeah, so some credit unions I know, and that is a good return in this economy. But I just say to people, understand the risk associated with the credit union. And if you drive down the road, you will see 50 credit unions, and they come up fly by night all over the place. No offense. You have to do your research. Yeah, so credit union is just about doing your research. Credit unions, as you said, you can get good return from them, but a credit union is really not meant for growth. While it's a share, you really have to understand what the credit union, and do your research, because any credit union, I'm familiar, and I'm not saying anything about Apex. I'm more familiar with Venture because I'm in Central. That's the only reason. So I know for a fact that they have had consistent good return over the years. You can see them growing as a company kind of thing. So I say to clients, I encourage some clients to invest in Venture just for the bridge, and just based on where they are, where the investments are, and for that diversification opportunity. But again, it's to do your research and see where that stands as well. My only concern with credit unions, to be honest, is that I am not sure, and you really want to check this because they have really not come under the purview of the central bank as much as yet. So I am, even with a deposit product, that would be my only concern. But again, and I'm just talking about Venture because I know them, not guys. But again, just because I am not a member of Venture Credit Union, but being in the area, I have been to the AGMs, and I know some of the things that they are doing to make sure that they have things in place to buffer kind of thing. So I do have an issue with that. And again, it's just to do research on what you're investing in. And for child education, I would never recommend a term deposit. So what you want to also do is to make sure that your investment kind of diversified, as you were saying. So you have people who have the everyday needs, which is like a regular savings account. At the end of the month, really, your savings account should have no money in it if you're really investing properly. Sometimes people, in the bank, he getting paid and he don't have a cent. He really not supposed to have any money in his account, because if you really plan properly, at the end of the month, you're not supposed to have any money in your savings account, because that is really just to cover your everyday expenses. If you budget properly, from the time you get paid, that money should have gone out towards your goal-related expenses. It should have gone out into your emergency fund, that kind of thing. One of the things we see all the time, somebody come in the bank to buy a car today. We give them the money for the loan for the car and the money for the insurance. Next year today, they're coming back for the money for the insurance. They had a whole year. So I have to refinance that whole loan to give you money for insurance. Think about that. Think of what you're really paying out there. So it's kind of understanding. So that is why some of the things that, like I said, that's a perfect situation for us to do. Or even if you want to say, okay, every month my insurance is, let's say $5,000 every month, and even if you don't save all, you could have saved some, because you always knew from the past year that this was coming up. I mean, a bank would love to do it because we make money. Even a credit union, we make money off of it. But for you, from your own personal standpoint, that's really not something you should be borrowing for. Really. I mean, things happen. You may have saved on something, come up the tire blow out and you have to use the money. But as far as the plan concerned, those are things we want to kind of plan for. So we don't have to dip into the child education, because in some instances, the bank can't give you, because they went elsewhere and got a loan to another that service at premium, so we can't give you that loan. So then you have to go into the child education fund to take out that money for that. So we just want to make sure that we cover all our bases, which are daily expenses, or emergency fund, or recurring expenses, and then for goal-related stuff. And it may not be child education, to be honest. It may be for to own your own home, kind of thing that you're saving for. That down payment on the home, those kind of things would be all fall under that bracket. So just want to address a few things. One, I specifically didn't want to talk product because I didn't want to talk specific to institution. Because as you know, as a matter of fact, I started to say unit trust. Because I'm really just looking at product, not necessarily the institution. Because most, like a mutual fund, you could get it unit trust, FCB, social, some credit unions have it. So I really don't want to dwell too much on the institution. It's to really understand the product. People think they diversify, so they went the FCB and open an mutual fund. They come RBC and open an income fund. But it's the same fund, and all of them buy the same bond. So that's why I really don't want to dwell on institutions. And then you talk about looking at, maybe you came in late, but that's the first thing I started with saying. You may want your child to be a doctor or a lawyer. Your child may be an excellent hairdresser who could go to New York and make millions of dollars. That's the second thing. The third thing with the insurance is what I said is, for somebody who has, like for me, which is why I said look at your situation. From my job, my children fall under my insurance plan. Up to $3 million they get coverage. If they get sick, I have that. If I have $200 to save for me, my specific situation, I would prefer to put that in a savings plan, a growth plan for them, rather than put it in an insurance fund. Because if they get sick, I take it out, just as I take it out the insurance, but just for and that is my choice. Somebody else in my same situation will look at it and say, this is not what I want to do. But like I said, it's just understanding that what you have to do is you just understand your options. But I know that people, I have a client now who says $5,000 a month in insurance plan, and he don't have a pension plan in there. And that's just me going through, and I'm like, and he didn't even understand that. But it's just understanding what you're getting involved. That was my point of view. From that perspective, it's just understand. Knowledge is power. And sometimes what we don't know what we don't know. But it's just understanding those options. And remember to no bank wants to bank everybody in a country. Let's be honest. No credit union wants to bank everybody in a country. Because it's really, and no credit union should, and no credit union can. Because some people, a credit union is just, the model is just not for them. A commercial bank is better for them. The experience better at the commercial bank. So it's really just understanding, they have all the players in the market. You have all kind of insurance houses and all kind of things who have savings accounts and deposits account now. So it's just understanding what model works for you. But this is really just about talking about, I just wanted to talk about the different investment instruments available and understanding for your goals what is best for you. And really, and I tell my children all the time, if I had known what I know about financial planning, I would have retired, and right now I'd be on a beach somewhere and somebody else would be talking to you all. No, honestly, because my first job, I had a good time. Every time I get paid, I went and buy stuff, kind of thing. But now my children know differently. Because they always hear the conversation. So even my daughter's like, now she has to open her investment plan and kind of thing. And they have been saving since long time. And it sometimes says understanding children as well. Because my big daughter, I always tell her she'll die poor and the small one will die rich, but hungry. Because that child, no, she would have money in her wallet and her whole mouth corner white. And she would not, no, she wouldn't spend it. How much times like my husband and I just borrow money from her. And don't so like, even last week my husband borrowed money from her. And she's like, hey, I have $14. And she's like, you only need 6 more then to pay me back. She really knows her money. The other one, if she gets $5 now, she finds something down the road to buy. So it's a different training process for the both of them too as well, is understanding where our children are and how we train them. Because you could save money for your children very well, and they could squander it all. You know, people go to university and they're living up, they're having a time. And I had a client who took a mortgage, and this is what it is. She got a first scholarship, the daughter. But you remember when they get this first scholarship, she went to London and they got £12 for a coat. Where you getting a coat in England for £12? So the mother took a mortgage. But her mistake was she sent the money like for the year. Yeah. She sent the whole money for the, because she said to me, she said she was a very responsible girl. Yeah, she was responsible $500. You gave her $100,000. And then she has to divide that into pounds. That's a different level of responsibility. That didn't even last 2 months. So then she had to come back and we had to give her another loan on top of that to make, because she had enough money, yes, but for the last year she had to take another loan. But it's really about training them and investing kind of thing. I just want to go in a little bit about loans and understand. We really want to understand. Now, loans are good, but I have clients who come into the bank for a loan because rainfall today. I think loans serve a purpose, but I like when people come to the bank for a loan when they have planned to take a loan. You can understand what I'm saying. If you plan to take a loan to pay a mass, that's your choice, pay a mass, then that's fine with me. Because everybody, if we are working and we can't enjoy our money, the vegans better. Think about it. But really is understanding what do I need this loan for. So you need to borrow for your child's education. You would have sit down and calculated, okay, yes, I'm paying this amount of interest and I'm fine with, what is the credit union or the bank? I'm paying this amount of interest, I'm fine with that, but I have my capital here as a buffer. But you sit down and you thought about it and you made the decision. But loans are good. Understand that principle, as you were saying, some people qualify for more than others based on your income. A huge thing we have been discounting really badly in this country is credit rating. Credit rating is becoming huge now. You have bad credit, credit union not going to lend you, bank not going to lend you, finance, nobody's going to lend you if your credit is bad. So you really, really want to manage your credit. One of the things I have to mention, just for information sake, is that digital bill. People's credit have been dropping some points because digital, if you don't pay a digital bill, and this is the bill, those who have the postpaid, it is reflected on your credit. And sometimes people don't even realize that until they come to the bank or the financial house and we do a credit check and we realize, I didn't pay $200. Yes, go ahead. Any TransUnion, but any once you go to do a credit facility in it goes into any credit union, commercial bank, finance house, anywhere, or how you pay. It's how you, not how much you borrow, it's how you pay your bills. So you really need to make sure you can't pay your loans like how you pay TNT. You know, sometimes there's only pay TNT when we see due for disconnection on the bill, then we want to pay. We can't do that with your loans. You really want to make sure, and how that is going to affect you down the road is you may need to borrow for your child's education. Nobody is going to lend you. Long ago, when you come to the bank for a loan, we used to have to send a letter. So let's say you have a loan at Apex. Okay, let's say you have I know Aero Services. I was thought it was Apex. Yeah. Let's say you have a loan at Aero Service Credit Union. We have to send a letter for Aero Services. They take a month to send it back. That's how we get a credit report. So people still come to the bank. You have any loans anywhere? No. It takes a minute to find out. And then you see they didn't pay the loan for the past 6 years and they come to another institution. Nobody is going to lend you. I say to people all the time, if you want to borrow money from the bank, think of it as your friend borrow money from you. If your friend never borrowed before, which comes back to his point, your friend never borrowed money from you before, but they come to borrow, you'll be like, I don't know if to lend him, no? I may give him less than he asked, so let me give him a little try and see. If he borrowed before and he pay you back, you're like, yeah, sure, you can get anything. If he borrowed and he didn't pay you back, something you find in a story to tell him why he can't get the money. It's the exact same thing. It's understanding. And so sometimes people are like, I never borrowed before. That's not necessarily a good thing sometimes. It's good to have that credit rating. So I tell people you could start sometimes with a small credit. Go ahead.
Okay, where would I want to say?
You could go to TransUnion. Yeah, and you can do. I think they charge $75, and you could just do a credit report. Have you borrowed before? Then you wouldn't have anything. So then you'll be wasting your money. If I will? Right, yes. So sometimes what happens with debt is that we see clients come and they owe Apex and Euro and RBC and I want to just touch a little bit on Island Finance, but I'll come to that, yes. And, no. And they owe everybody. And they really can't make it. I had a client last week who was a police officer whose net income was $10.62. He has 3 children, and his wife is a homemaker. But she just do a little thing on the side, she just do a little braiding here. So I guess she's surviving on whenever she gets her hair to braid. And she can't do it as much because of the children and whatever. How we help those people is really to do a debt consolidation. We try to put all your debts together into one loan where you have one smaller payment. And you can't, that way it makes it easier for you. The challenge we have is many times those people go back into that hole. And we see, and that client we couldn't even help because it was like his fourth time. And it was like, are we really helping you? You understand? Are we really helping you to be better? And the other reason was that he wasn't paying the debt. So even if he was paying, if you're in I think I'm 1062, you really can't pay all those debts. And I don't understand how you end up there in the first place, because we're really not supposed to be lending you that much. And those were loans that he had at institutions. So I don't even know how, I don't understand how he got there in the first place. But that's an extreme case. But in many instances, clients, the debt service is a little higher than normal. So we have clients who, they're making it, but they're barely making it. So we put all those debts together and we give you one loan, which makes the interest smaller. I just want to talk a little bit about, sometimes the easiest is to get the debt. Please ask a question when you go to borrow. People are paying now 33% interest on a loan. But they got it. I went in and I called a man and he answered and he said, come for the money tomorrow. He was paying 33% interest. You know what is 33% interest? Yeah, you really want to be careful. I mean, sometimes you may go to the bank or the credit union, and to be honest, that's why I said the model of the credit union changed. People don't realize now people get disqualified from loans in the credit union every single day. You can't just say, I was with them 6 years, now when you get the loan, it doesn't happen anymore. You have to go in, your credit has to be okay, and they still, most credit unions I know still work with debt service ratio. They may not go to 40 at the commercial banks, they may go a little 45 in some instances, depending on who you are, but yes, they would not give you a loan just because you have money with them. I have seen some that do it, and they really have put them in a bad situation, but most of the better ones will not do it. So it really, and it really is, sometimes we get no to a loan. And my only thing with clients, and even with the commercial banks, is we really need to educate our clients. Say, didn't qualify for the loan, why? And how can I fix it? Telling me no, and I go along the road and I'm like, well, that hasn't helped me in any way. Telling me no because so and so, but this is what we can do. I have told clients already who come for a car when I was in lending. You can't get the car now, but here's what to do this. And they came back for the car loan. And they were ever grateful to this day. I still have clients who call me from when I was in lending based on that. But I don't think that as the financial institution as a whole across the country, and I want to balance what I'm saying. I don't know if we haven't done a good job of educating people, or if people are as much not interested in being educated. Yeah. Because sometimes when you say to people, you know, it's like sometimes we have financial planning seminars in companies during their work hours, and it's really just to talk about financial planning. And I really do not, and they know that, because sometimes it wouldn't even be under the RBC umbrella, it would just be financial advice seminars, and people wouldn't come. When we go to sell loans, if we say we have a loan, say, or we come to talk about loans, and even sometimes during the financial planning seminar, somebody put their hand, when are you going to talk about the loans? But they really, all clients are interested in is how much I can get, how much I have to pay when it comes to loans. Nobody talks about interest. How much I can get, how much I have to pay, that's a big question. But you really want to ask those questions. We used to charge a few years ago 25% interest on a loan. Commercial banks, nobody never, now that the economy had it, now we have people asking those questions. But people really didn't care, they just wanted to know how much they could get. And then people, even when you go to invest, what people ask, the question people should ask when they invest is what they do not ask. So like when you're investing, you really shouldn't ask what the interest rate is. Because like our income and growth fund, return income and growth fund is doing, let's say 11%. It's doing 11% because where this fund is now. That is what it has done over the past year, based on where the market was the past year. That doesn't say you're going to get that next year. But if you ask me what it's paying, that is what it has paid. And but that is really not your question you should be asking. You should be asking me, based on where I am and what I want to accomplish, where should I invest? What's your recommendation based on where I am? Give me some options. That's what your question should be, not what it's paying. And so really those are the questions we want to ask and understand. I mean, it's still, if a fund could do that, it still works well over the period. Sometimes we have like income funds and clients who say, I'm losing money in the fund. Because the bond market is going down, you are going to have a discount in your thing. If you are investing, as long as the fund is doing what the market is doing, you are in a good place. And understand, it's so easy now to know what the market is. Every time you put on the TV in the morning, you see bonds going up, bonds. And you don't have to be in finance specialist to understand these things. You're in stock, the stock market is going up, your stock's supposed to be going up. Or your stock fund. If your stock fund not going up, your fund manager is doing something wrong. If you're in stock and the stock market going down and your stock's going down and your stock's going up, your fund manager doing something wrong. Because there's no way the whole stock market going down And he have a secret he alone have, or they alone have, that their stuff going on. So that's why, like, when you see, like, what's that credit union? ACU. Was paying those exorbitant rates, and nobody else in the market was paying it. Clico as well was paying those high rates. Nobody else in the market. Something is wrong. There's absolutely something wrong if they are promising you those rates. Because look at where the market is. If the whole market at 5, a credit union, which makes money, they take in money, they lend and they pay you the difference. They really don't earn any, they don't own profits. Profit per se, like they're making money. And they are paying 5. And you have Clico paying you more than that. What are they invested in? What secret they have that a company that's making no profit, they are making more? Something is wrong. So we really sometimes have to understand, and don't always run for the shiny apple. Especially when you're looking at your child education fund, guard that with, really do your research and guard that. Because people just come with all kind of shiny objects to catch your eye. Just stick to what you know and what has worked for you, and what is, and I don't want to say safe. I'm using safe here, safest in your situation for you. Credit cards is another thing for those who have children going off into university. As soon as my child turned 18, I put her on my credit card because I just wanted to have that credit rating. Now, she don't qualify for the card, she don't work anyway, but she gets that credit rating from my benefit because it was a good way to have that credit rating for her, just based on where we are going. I remember when I trained for financial planning, because I trained in Canada, from the time children come out of school, they give them a credit card. Just to have that, because remember they're huge, you're always saying about credit rating, credit rating. We are now going that way, so you really want to, but let them understand what it is for, what the option is. The option is not for you to go out and have a great time. And I didn't put on my credit card to say like mine with my limit. I split mine into and give her a small, very small limit. And so she has that she could use and still get that thing. So those, because you love them, you don't give them a credit card to 15, 20,000, they're going to spend it. Except we have the really good ones. And it's a good way, and so like if you're going about to university, it's a good way for them to have a credit rating and for you to get funds to them easily. Especially with what's happening now with US, it's a good way they could just take it out abroad because you're not getting the US to send to them. Anyway. Our overdraft limit is another thing that people use. They take an overdraft limit and they use it as they need it, but you only pay interest on the overdraft when you use it. So let's say a child abroad, you have the overdraft limit established as you need it to take out some and you can always pay it back. It's a good way to have that emergency fund in case you need some money. And even if they study locally, because remember with what, now sometimes you need a book, laptop crash, some kind of thing, you may not want to go and take a whole loan for that. You can have that overdraft facility just as a buffer there for them. Trying to run through because I know kind of over my time. Sorry? A what? With time? I am? Okay, well, thank you. I just want to talk about some pitfalls with credit. While it's excellent, yes, to take a credit, we don't want to be living in credit for everything. And I talked about that before. It should be a choice that I have made to do that. Credit cards, understand with credit cards that credit cards interest is high. And it's high because it's a receipt credit to the institution. So if you can pay off your card at the end of every month, please do. And just pay that monthly, you pay no interest, you just pay that monthly fee and you don't pay that interest. And then you get the benefits of the planners, whatever. And then living in overdraft. Overdraft is an emergency fund, as I said. So the child needs some money to buy, let's say something, you get some money, pay that off. Once you use the overdraft, you pay interest. What you're trying to avoid is that interest payment that you're going to pay everything. Because that money you're paying on interest could be used for something else. And as I said, we understand always that you have emergency situations. And something may happen, you may get we have people now who, they may not be getting fired, but they're getting demoted in the job. So your salary was 30,000 a month, is now 20. But the bank, you still have to pay your loan, you still have to pay this, your children still want everything that they used to have before, which they can't have, but sometimes you may have to go into the credit card, and you may have to go into the overdraft. But don't make that your way of life. You can't say just to understand that. And what I tell to clients, start where you are today. If you could start to save $50 today, start with $50 today. And when I just started to become a financial planner, I wasn't saving as much. I wasn't saving, let me be honest. And from that point, I was like, okay, let me start saving. And I really started with $100. And what you also want to do is to understand what you're saving for. So if your company have a pension plan that you can save towards, you could do that for your pension. But you still have something else, your child education. So you start small, and every year you get a salary increase, or even if it's every 3 years. When you get that money, start to build up that plan. And once you see savings growing, you kind of feel, okay, you're doing good, I want to save some more. But start today. Start small, start where you are today. make it automatic. Do your standing orders, do something that will make it force you to save, depending on who you are. And you also I want to talk a little bit about, this really is not education so much, but it's about you. So I spoke about the children, and I want to talk about the adults now. For your children's sake, you want to make sure that you have a life insurance plan that covers them, that covers you in case anything happens to you for your children. Insurance, people think that insurance is supposed to make them rich. It is not. If your car is insured and you get in an accident, the insurance company is going to give you back a car or the value of the car as it is today. It's not going to give you $1 million for you to get it. The insurance plan is really just supposed to be able to provide for your children and give them the same lifestyle they have if you were to pass away. So sometimes you don't need a $10 million, no. Most times you don't need a $10 million policy. What you need is something to have your children comfortable. So you want to make sure and have an insurance plan that covers you. And again, if you have one at your job that is doing the job, and especially one that will continue after retirement, then you really don't need to go out and buy one if you have enough coverage at your institution. And in some instances at your company, you can go out and take more in the company itself. They kind of subsidize for you to go a little higher, so you could explore those options as well. Insurance. Also, in addition to insurance, you want to also check out your medical benefits. You can, if you don't have a medical plan at work, and even if you want to subsidize your medical plan at work, there's some medical insurance coverage as well. Because like Marvin said earlier, if your child gets sick, all that money is going to go, and then when they get to 18, you don't have any money. So you want to have that medical plan in place that covers. But you have to know always know what you have. Just a little bit about retirement plans. You also want to have that as well. Lots of companies we go into. You have a pension plan, nobody knows. Or you cannot know. You're really supposed to know if you have a pension plan. Because if you don't have one, then you would need to have your own pension plan in place. Or else that money you save towards education, when you retire, you yourself going to have to go in it because you have nothing else in place. So understand if you have a pension plan, understand if you need one. For some people, they're okay with NIS only, and if you think that will work for you. If you're confident, because most people think it would and it wouldn't. If you're confident that it will work for you based on where you are, then that's fine. If not, supplement. But it's just to really stop all the holes so you really have that it's kind of protecting that fund that you're saving towards your child education. And I read a quote when I was doing this, and they say if a man invests if a man empties his purse into his head, no man can take it away from him. So I kind of try to teach you, our children are so brilliant that they think we know nothing. So, but really I try to teach my children, whatever you put in there, nobody can take it away. And so and sometimes, as I said, educate little courses that we can do for them to supplement, to build them up now, little things that they can learn to do, kind of thing. Teach them to learn to sew. We'll not say here about a seamstress. And how much time you needed a seamstress. But you're kind of like this thing here with a stitch on it, with a rip on it so long, and it just there, and then eventually you throw it away because it will never fit. Think of how much money your child could make. And they don't need to be their job, they could do it on the side. My hairdresser just do her hairdressing after work, and we go by her after work. She still has her job, and I'm sure every day she makes much more money than me. But give them a skill, because they also want to, and why that is helpful too is that when they go off to university, they also have something. You can imagine if you're in the dorm and you can do hair, you can make some money as well. So all those are some skills and things, and we really want to equip our children. While we're doing our part, have them do their part as well. But also understand what do you want to provide and how do I provide that for them. If you really don't want to pay for them to go to university, but you want to give them something else, and then again sometimes it's what do we want to give them. It could be I want to leave them with a piece of land. Something like that we may want to do for them. My children not getting that, but somebody else may want to give that for their children, but it's just understanding what are my goals for my children and how do I help them to achieve those goals. So that's really where we are. Well, I'm done. So thank you all for your time. And my name is, as I said, Lesa Cruikshank-Simon.